All right, so let's start. Just have a very brief look at our question. So we've got Hypertrons, listed company, financial director approach you for advice since you are the technical advisor of Heads, Lang and Sarobi. The following issues have been referred to you for advice. The accountant calculated a provisional profit before tax of 9 million, but certain aspects listed below have not yet been taken into account. And we've got points 1 through to 8. All right, in fact, we've got 9 because basically it just says ignore tax. First point is prepare the journal entries, all right, for the year ended 31 March 2007, and B, calculate the revised profit before tax of Hypertrons for the year ended 31 March 2007. All right, so let's work our way through it. As with most questions, all right, always a very good idea to actually go and say to yourself, well, most of the questions nowadays are kind of like, here's a little paragraph, identify that paragraph, isolate everything from it, deal with it, move on. All right. So what we're going to do is the revised solution is also on your disk. Well, basically we're going to start over. We're going to basically do A and B together. So we say to ourselves, well, what is this revised profit going to be? Okay, so we're going to start with 9 million. All right. So that was the given profit, and we'll work our way all the way down to what the revised profit should be. So let's go and deal with each of our scenarios, do the journal entries, etc. All right, as you can tell, I've got a little bit of limited space, so we're going to do maybe 1 or 2, maybe 3 items together, and then put those on, clear the board, go again. All right, let's have a look at the first point. 1st of August 2006. Now remember, we've been asked to do the journal entries for March 2007, all right, as well as the profit for March 2007. So we've got 1st of August 2006, that's in our current year. Hypertrons borrowed 10 million rand from a financial institution by way of a bond. This bond was issued at a 15% discount, okay, very important, as a 9.25% coupon rate payable annually in arrears and is repayable in total on the 31st of July 2008. All right, so what's that, 2 years' time. Hypertrons incurred legal and other expenses of 500,000 rand while arranging this bond. Interest incurred on the bond was not taken into account in the provisional profit before tax of 9 million rand. First question you need to ask yourself is, clearly it's a financial instrument, all right? But we're not going to say to ourselves, well, is it a financial asset or financial liability? Well, clearly if we've borrowed the money, it can't be an asset, so that's out the way. So we're now into our financial liabilities, and the only really 2 that we have. We have fair value through profit and loss or other financial liabilities. Amortized costs using the effective interest rate method. And that's what this is, all right? So what we've now got to do is we've got to say to ourselves, all right, let me see what information I've been given. I've been given the fact that I've borrowed 10 million rand. It was issued at a discount of 15%. I've got a coupon rate of 9.25%. So I've got I've got N, which is 2, so that's fine. I've been told that I incurred costs to actually get out the bond. And what do I know? Well, if it's another financial liability, all right, I've got to include those costs. It's only fair value through profit and loss where costs related to getting the liability would run through the income statement because the movement would run through the income statement in terms of that financial asset or liability. So I must actually capitalize those. I mustn't forget that. And it says that interest incurred on the bond was not taken into account in the provisional profit before tax of 9 million. All right. So first things first. What we've got to do is we're going to come along and say to ourselves, well, I have a present value. I'm looking for a future value. I'm looking for N. And I have a payment amount because what I'm ultimately looking for is I. All right. Remember what I said when I was going through it. I said to you, amortized cost using the effective interest rate method. All right. So we've identified the fact that it is an other financial liability, amortized cost using the effective interest rate method. And we know that if that thing was issued at a discount, then in terms of my graph, if you just remember the graphing principle, all right, I know that in 2 years' time, all right, I'm going to have to pay 10 million, but I took out X amount today, all right. It's all very well saying to me that the interest rate is 9.25, but to get from here, all right, that little dot over there to that little dot over there is not going to be 9.25 flat rate. All right, I'm going to need an effective interest rate. So let us go and have a look and say, well, if I'm looking for I, what is the information that I know? Well, I know that my present value, all right, is clearly going to be the following. I took out 10 million, so that was easy. I subtract, what was it? 1.5 million, which is 15%. Okay, remember the bond was issued, or the loan was given to me at a 15% discount, all right, minus 0.5 million, all right, which were the costs incurred. Okay, remember other financial liabilities. Same thing with financial assets, all right, held to maturity, loans and receivables, all of that available for sale. They all run through the actual underlying investment, whereas fair value through profit and loss, either asset or liability, will always run through the income statement. All right, so we've got to go and capitalize it, if you want to call it that. And that gives me a figure of 8 mil. My future value is 10, as I've pointed out over there. All right, my N will be 2. And my payment, the amount of money that I'm having to pay every single year, is going to be 925,000. 10 million times the coupon rate of 9.25%. 925. All right. Plug those all into your financial calculator. All right. The trick, okay, just remember, is over here, if you're going to put this as a positive, put these two as, put the negative 10, negative 925. Likewise, if you're going to put that as a negative, make these two over here positive, so that you don't get a garbled answer. All right. And you will find that when you do that, you're going to get I of 22.78%. All right. So nothing too untoward from that. Now you say to yourself, well, okay, that's great. So I've got that information. All right. But now what am I going to do with this information? Well, let us go and piecemeal our journal entries. So I've got my debits and credits. Okay. My first journal entry is obviously took out the money. Okay. So I went and I said to myself, well, debit bank, credit other financial liabilities, all right, bond or whatever the case may be. And in this case, I took out 8.5 mil. So that was nice and easy. Likewise, unfortunately, I had to go and pay some costs to get that. So I'll go debit other financial liabilities and credit bank. Remember, we're not expensing those costs. So that's 500,000. Hence the reason why I get 8 million present value. All right. So that's all fine and well. Now I come along and I say to myself, well, that's the first thing, but what hasn't been taken into account at all yet is the interest. So I've now got to go and say to myself, well, clearly if it's a borrowing, then I've got interest paid. All right. And very importantly, go back to the question, you couldn't go credit bank. All right. You can't go credit bank because they say to us that the money is payable annually in arrears. So in other words, on the 31st of, July 2007 is when the money will be paid. So what I'm going to do is I'm going to go credit accrued expense or other financial liabilities. All right. I'm not going to overly stress about which one I'm taking it to. I just want to show my examiner that I understand that it's not a bank account. All right. What's my calculation? Well, very straightforward. I took out 8 million rand at an interest rate of 22.78% per annum. Okay, please note that's a per annum figure. Multiply that by 8 over 12. Okay, let's just quickly check. August, September, October, November, December, January, February, March. All right, almost forgot that it was March. So that's my 8 months. And you get a figure of 1,214,933. All right. Now, I do appreciate that, as I said up front, this does come from a question from the title letter itself, all right? But at the time of recording this DVD, we don't have the title letter, so I can't tell you exactly which question it is. But you will notice when you eventually find hypertrons in that particular title letter, you'll see a slight difference in terms of the numbers. Just please note that it's rounding, all right? So I'm not going to get too stressed up about the rounding, and nor should you, all right? So when you go through it, just remember that it is probably just that rounding issue. So my interest paid, I must take into account 1,214,933 drop, all right, interest paid. And that's how we deal with the first one, all right. Not too daunting, Okay, you do need to know your theory, obviously, because you need to understand, okay, hang on, what type of financial liability am I talking about? Fair value through profit and loss, other, all right? If it's fair value through profit and loss, obviously it goes to the income statement. If it's other, it's amortized cost, effective interest rate method, and this whole aspect over here of having to recalculate I, all right? So that was that first point over there.